Hello, friends. Today I'm going to talk to you about inflation. I'm going to talk to you about consumer spending. I'm going to talk to you about real estate and some of the other emerging trends that I'm seeing in the market. So I think you're going to find all of this information very, very helpful in making your near term financial decisions. Now, as a reminder, I'm not an investment advisor, so I'm not here to tell you what to buy, what to sell, or anything like that. Anything I say, take it as an entertainment or educational, but nothing more than that. Perhaps a starting point for your own research. If you find value in what I have to say, and you want to dig a little bit deeper into it, then I encourage you to join our coaching program where I share my thoughts almost on a daily basis, and I conduct bi-weekly live discussion calls where all the group members together and we debate all the ideas, what's happening in the market that can help us prepare for what's coming next. So if you're interested in that, reach out to me. I'll be happy to help. Other than that, I will also encourage you to sign up for our Wealth Summit that is coming up on November 16th in Newark, California. Full day event. But if you sign up right now, in the month of August, then I can most likely I'll order a nice little planner for 2026 that have all kind of financial informations and all kind of tracking for our goals and simple things that can help us become a better human being, that can help us become a little bit more productive and help us achieve our goals in 2026. So I would like to give that away, but only if I can get enough people to register in August. So those are a couple of important ones. I do have a real estate webinar coming up next week, and I will also do a meetup in Fremont, California, for anybody who wants to come and say hello to me. So I'll be available to you guys next week on Saturday. Now, let's go back to our first question. So first question is, Deepak, what do you think about luxury brands and luxury spending? A lot of people are struggling in this market. You see those kind of businesses might get hurt in this economy. That's a that's an interesting one, right? So I'm going to point you to a couple of different sources that can help you better understand what's happening. See, banks usually have more information about economy than anybody else because they have a lot of data. They can monitor the spending. They can monitor a lot of trends. So I'm going to point you to a couple of banks: Citibank and Chase Bank. And I want you to take a look at their luxury card. For example, Citibank recently launched a luxury card which has an annual fees of $595. That's a pretty steep price to pay for somebody who is rich, who is spending a whole lot of money. Then we take a look at Chase. Now, Chase already have such a card known as the Chase Sapphire Reserve, if you're not familiar with it. And they have increased the fees to $795. That is that's a lot of money to be spent on a card. Now, why would a bank do that? Banks do that because they're showing confidence that affluent, wealthy Americans are going to continue to spend on travels. They're going to continue to make their purchases because they have plenty of money. Slight inflation or anything like that, that's not going to stop them for spending money. So if I was investing my money right now, I'll be looking into luxury brands that are most likely going to do well even over the next couple of years. So that's my take on that. But again, I don't have that data, but banks do. So I'm kind of just monitoring what banks are doing and making my judgment based on that. Another one, people, similar question in the same line. He's asking, what about people who make less than 250K? What about them? Are they going to reduce on spending? They're most likely going to feel the pain from inflation. Yeah, so that's an interesting one. And I'm glad you put a number, 250K, right? If you make more than 250K, most likely uh, buying is not your problem, right? You can, if the prices go up for consumer goods for, let's say, 10%, 20%, it's not going to bother you a whole lot. Like, how much do you really spend on groceries or your daily items? Maybe $30,000 a year, $40,000 a year, maybe $50,000 a year. So if it increases by 5,000 or 10,000, and you're making $250,000, it's not going to bother. So if you over 250K, it doesn't impact you at all. If you are between 100 to 250, you probably notice it, right? But I don't think you're gonna stop spending, right? So that's not going to happen. I think you're gonna it's yeah, you will feel like, okay, prices are going up, but you're going to continue to spend. And then comes the people who are below 100K. They are certainly going to feel the pain. So I hope Trump administration will come up with the some solutions to ease their pain as well, and they already are. For example, we already saw some tax policies that's going to help them, child credit that's going to help them. and then on top of that, lower interest rates, that's going to help them. So there's plenty of help there to offset some of this pain they might get from inflation. So do I see consumer spending slowing down? Most likely not, because of those reasons. Yes, right now it's kind of like a shock. Like, for example, when they show up the inflation report, or they makes the news, it's going to make a lot of people panic. I'm with you there. But over a long term, over the next 6 months, a year, I think the other policies that are in play right now are going to work out just fine. So yeah, you're gonna hear a lot about it, but I don't think it's going to have any practical implication on your day to day life. So that's my take on spending, both in luxury goods as well as for people who are making 250K or less. Next question comes from real estate. There's a lot of talk is going on about interest rates coming down. Do you think that is going to help the housing market, especially now that Warren Buffett have invested a lot in real estate? Yeah. So what he's talking about is, if you pay attention to real estate market, or at least Berkshire Hathaway or Warren Buffett, he recently invested in real estate stocks. I think D.R. Horton, maybe Lennar. I don't know. But I know he invested in few real estate stocks. You can probably easily find that information online. So the question here is, look, Warren Buffett has invested in real estate. Interest rates most likely going to come down. Is that going to help the the home builders? In matter of fact, and I'll add to it. Would that also help consumers and all that kind of? So let's take a look at broadly. Number one, the inventory for housing is up, and it's been up for quite some time, and not just in certain markets, in a lot of markets, including California. If I'm not wrong, inventory in California is probably up maybe 30 to 40% right now, which is very difficult in California. Usually people are competing on multiple homes. But in spite of that, in spite of high inflation, in spite of people fearing about immigration, in spite of people worried about losing their job, in spite of layoffs, so we have seen a lot of shocks, right? But in spite of that, home prices are not falling. Now, you might argue with me and say, well, that's not really true. Prices in Austin are falling, prices in Florida is falling. Look, those are headline prices. You'll be quite surprised. I mean, I'm in Austin, so I can tell you home prices in Austin on average are down about 5%, in spite of them being up 30-40% in the last few years. So it's not even meaningful decline right now. The only thing is, you have better choices. Um, so that's number one. The prices are not falling. So a lot of people are putting faith in Fed's cutting rates. Now, when Fed cuts the rates, it might help, your 5-year loan or a 7-year loan or something like that. It's not going to have a meaningful impact on your 15 or 30-year mortgages, because they kind of follow the 10-year yield. And where that 10-year yield goes will depend upon how the market perceives the rate cut. So it's not the Feds don't get to decide that. It's the market's perception. If market feels that we are heading into recession and that's why rate cuts are coming, that can actually spook the market. In matter of fact, in earlier rate cuts, 10-year yield actually went up. So I don't know if cutting the rates is going to have a meaningful impact on affordability. Okay. Number two, we need to go back to the basics and figure out what's going on here. Is it the affordability, or is it the supply, or is it the demand? What is the issue here? I think affordability is the obvious one, because you can easily do the math. A lot of people cannot get into the mortgages right now. And that is one problem. And I think if Trump administration is successful in navigating this financial landscape, maybe he's able to bring the rates down, and that can hopefully make homes more affordable for a lot of people. I don't think it's going to happen as fast as people are anticipating, you know, but it can certainly happen. But the bigger problem here is that there's a lot of demand. People want to buy homes, and there's just not enough of them on the market. So that's the real problem. So if we can build more homes, more affordable homes, and honestly speaking, even the builders are part of this ecosystem. So, for example, this is a question for you. Let's just say that interest rates do come down, and a lot of people get excited and they want to go buy the home. So they go running into the new home builders and they want to buy the homes. Do you think builders going to reduce the price because there's a lot of demand? Of course not. In matter of fact, they're going to do the exact opposite. They are going to increase the prices. And when they increase the prices, guess what? The affordability crisis gets even more worse. More people cannot afford it, right? So it's a catch-22 problem. It's not that easy. I think what we need to do is we need to increase the supply and decrease the rates. And if we can do it in a very systematic method, then we can solve the long-term challenge. Otherwise, real estate prices is not going to come down. So that's my take on that. If you're in market looking for real estate, I would say don't wait for those rates to come down. That might not necessarily be the smart move. And if that does happen, you can always refinance and get a better deal. So nothing there. All right, next question. What do you think about debt? So I don't know. Maybe you're talking about the national debt. If that's the question, I don't think about it. I'll let the big guns think about that. I'm not qualified enough to answer that question. I know it spooks the market. People always get worried when they're talking about debt. Uh, but again, that's not in my control. There's nothing I can do about that. I can tell you a few other things related to debt. For example, take a look at household debt. Household debt rose by about $185 billion in Q2. So now it's sitting at $18.39 trillion. So people are borrowing more money. Mortgage debt. Now, you would think that, people are not buying homes, so mortgage debt will be actually lower. Not true. Mortgage debt also jumped by 131 billion. Now we're sitting at $12.94 trillion in mortgage debt. Now, problem is delinquencies are actually ticking up, almost 1.29%. So I think rate cuts can certainly help with that. We don't want people to lose homes. Student loans is another interesting story. Student loans are also surging. 10.2% of $1.64 trillion is now outstanding, and 90 plus days late or more. So that is also not looking good. So I think some cracks on the economy are there for sure. But if I were Jerome Powell, um, it's a very difficult decision, to be able to take all that political pressure. You have some people are struggling because of these rates, and then at the same time you have inflation that can obviously hurt, and then there are jobs report that are not looking too healthy. So it'll be interesting to see what he does. He might say, what, let's just hold and wait a little bit more to get a little bit more clear picture, because we only have, one or two data points, and even those data points are being disputed. So maybe we don't really have as clear of a picture. So he might decide that, or he might say, what, let's just give a market a little lollipop and let's give them a 0.25% cut, and then we go from there. So those are the things that I'm seeing in the market right now. But overall, I think market is going to continue to be shaky for some time, and then we'll see how things go in November and December. So far, if you ask me, Q1, Q2 market deserved to be high. Why? Because the earnings were there, right? The companies are making more money. So if they're making more money, why should we slow down anytime soon? So I don't see any reason. Valuation could be one reason. You might say, valuations are super crazy. Well, not for everything. There are plenty of stuff available in the market that is extremely reasonably priced, and those are the kind of things we talk about in our coaching program. Is that you don't want to become complacent in the market, but you still want to take advantage of the market. So I'm, we're good there. So that's all I have for today. I hope I answered all of your questions there. If you still have any more questions, or you want to talk more about anything in particular, then please share it with me, and I'll be happy to get back to you guys in the next video. But in a meanwhile, enjoy the day, and take some deep breaths. Market is going to be continue to be shaky. Relax, and then, like I said, if you want to come see me in person, I'll be available next Saturday in Fremont, California. So please take your time out. I know some of you guys have mentioned that they don't get enough notice about these kind of things, but I'm making these videos and sharing it with you on a regular basis and posting it in our WhatsApp group. So please take advantage of that. Come see me in person. I'll be happy to answer your questions that you might have. And then please do register for the Wealth Summit. I would love to give away those planners, but only if I can get enough registration in the month of August. So if you're planning on coming, please register. You're going to find I think this Wealth Summit, we are going to deliver more value than we have ever done before. That is so hard to do. It's so much work goes into organizing the Wealth Summit. But this year, I think you will be amazed as to what we are going to be able to pull off. So please do register, and I'll see you at the Wealth Summit, or hopefully at the Meetup in Fremont next week.